Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the micro bearish scenario where we're looking for a triple 1-2 to the downside for eventually much lower prices to come, as we are looking for an explosive wave 3. The problem, however, in this scenario is the different ratios between the 1-2s, and let me explain by starting about Elliott Wave degrees. The highest degree Elliott Wave count is the first 1-2, as you are looking for a wave 1, wave 2, then a wave 3, 4, and a wave 5. Inside the green wave 3, we're looking for the blue count, which is then a 1, 2, 3, 4, 5, finishing green wave 3. But then inside the blue wave 3, we are looking for the white count in a 1, 2, 3, 4, 5. So the white count is the lowest degree Elliott Wave count. Preferably in a double or triple 1-2, each lower degree Elliott Wave count is shorter in time and price compared to the previous structure, meaning that you want your first wave 1 to preferably be the longest in time and price, and then have a shorter blue wave 1 and a shorter white wave 1. Same with the wave 2s. But that is the problem over here in this scenario, because the second wave 1 in blue is longer in price than the green wave 1 over here. So if you take a trend-based flip from the high to the low of 1 to the high of 2, you get the 1-to-1, and you can see that the blue one is lower than the 1-to-1, meaning it is longer than the higher degree wave 1. That is not ideal. And then you have the white wave 1 over here, which is shorter than the blue wave 1. That's something, but as you can see, it is much longer in time compared to the blue as well as the green wave 1, which is also not ideal, right? Is it possible? Yeah, there's always probabilities, but it is not preferably something that you like to see. Also, the green wave 2 here retraced to the 0.382, less common target for a wave 2, more common for a wave B. This wave 2 hit the golden pocket, which is fine, and the Y2 reached the 786, which is also fine. What I also prefer to see in a double or triple 1-2 scenario is bearish CVD divergences building up between the different highs, just to show that there is a lot of absorption going on of market longs for then a big push to the downside. But in this particular case, if we open the CVD divergences shortly, there is no bigger bearish CVD divergence between the highs over here. You do have the small ones, as you can see, a little bit here, a little bit here, a little bit here, for example, but there are no bigger bearish CVD divergences between the high and the lower high. Wave 2 here, wave 2 here, or these highs, for example, which also lowers the probabilities of this particular scenario. And at the same time, that is maybe a good thing as well, because if price does move to the downside, there is a couple of things that we do have to look at. So let's go through the higher time frames, because if it somehow still plays out, even though the probabilities are not on the side, then we could be looking for a wave C. That is the more bullish option, where you then have a wave A, B, C, 5-wave structure, right? 1, 2, 3, 4, 5 expected, ending somewhere between the two 1.618s, between 31.7 and 33.1K, for then a reversal and a move to the upside, where also you're going to take all the liquidity over here, all the bottoms, and you might reach this key level and the 1-hour gap. Very nice, okay? All good, all fine. Now, if you go too deep, and that is the problem with the triple 1-2. If this is a 1-2, 1-2, 1-2, your wave 3 usually is very powerful. So the probabilities are quite high. You're going to push through the target of this wave C to lower prices. But that means we then have to look for this potential wave 4 of a higher degree. So we go to the 4-hour. And then if we look towards the downside, now the target is maximum the 0.5 over here at 31.3K. This is the whole common target area of 4, but most commonly the 302 to the 05, which is 32.4 to 31.3K. You don't really like to see candles closing over here. And the invalidation is the 0.618. So if you do get a triple 1-2 and then big amount of volume to the downside, invalidating the ABC over here because you go too low and you start closing candles all the way down here, then of course we have to look at this scenario where you don't want to see candles close here for still bullish market structure and a move towards the upside, finishing a wave 4 in a bigger corrective structure or potentially an ABC, right? Invalidation at 30.1K. But if you reach the invalidation over here, then the probabilities will increase that we are going down into the lower 20s or maybe even below 20K, because this is then the target for an ABC expanding flat over here, where the most common target for B is between the 1.236 and the 1.38, taken from the high to the low of A, with the 1.618 still being a target for a wave B as well. So we're not out of the danger zone, but then you're going to be looking for a much bigger 5-wave structure to the downside, with targets sitting between 24/7 and 18K, right? So the fact that the probabilities as it stands at the moment are not on the side of a 1112 is bullish, in other words. If we then look over here at a double zigzag structure, then this double zigzag structure is a WXY, where you have an ABC, wave W, then you have a short zigzag in wave X, which is a common structure for a wave X, and then you have another ABC to the downside in a wave Y, where wave A over here is a wave 1, 2, 3, 4, 5, very nice. Then we're looking for an A, B, and a wave C in wave B, and then we're then going to look again for another 5-wave structure to the downside in wave C, where the most common target for wave Y is between the 1 and the 1.236, which is between 33.4K and 33K. And if I then open some of the interesting levels, of course we have liquidity here, but also the final low, the double bottom here at 33.2K, which we can then potentially wick, close above, move to the upside in a typical swing failure pattern scenario. Now if we look for the target of wave C, we have to take the trend-based fib from the high over here, the high of wave X, to the low of A, to the high of B. And this is what lowers the probabilities a little bit of this particular scenario, because as you can see, the targets are not in confluence with one another. The wave Y down here is not in confluence with the most common target area for wave C. There's quite a big gap between the two, which is not ideal. Now, a less common target for a wave Y is the 0.618. If you toggle on the 0.618, then you will see that the target area for a wave C is in confluence with the 0.618. So that would then mean grabbing the triple bottom that we have over here. Let me open the range again. Triple bottom will be tagged, as well as the double bottom most likely, and then you reverse towards the upside. But honestly, if we take these lows, yes, I will be looking for a potential swing failure pattern and a move up, but of course it can go quite quickly towards the downside, because you got to imagine as well that big moves happen not because people are selling, but because stop losses and liquidations are being hit. People longing. Where are the stop losses? Down here, here, right? And the moment you start entering a cascade of stop losses and liquidations, it can go very quick. It can go very quick to the downside. So trade safe, especially the moment price moves to the downside. We do have a support area over here as well, sitting between 33.8, 33.9K. But on this channel, we don't FOMO, YOLO, and especially we do not catch knives unless that is your plan somehow. Then that is fine if you can read order flow and all that good stuff, right? But yeah, generally wait for proof of support, market structure changes, RSI, CVD, whatever it is that you're looking for that gives you more trust of going against a potential strong move to the downside, right? And then finally, we have this more bullish scenario where we are not looking for downside first, but we're first looking for a move towards the upside. And in this scenario, we're then looking for either a WXY sideways structure or a bigger A, B, and then a wave C to the downside. But as you can see, all of the scenarios are leading to taking the lows at the moment, which means the highest probability scenario is going to the downside. Even if you go up, even if you would take this high somehow, right, and then an A, B flat, you're still looking for a C to the downside to take the lows. That is currently the highest probability. But in this scenario, you're then looking for a wave A or W, 3-wave structure flat in wave X, and then or B if it goes high enough. And then you're going to be looking for a move to the downside in a wave Y or a wave C. And then potentially zooming out, this can be the first structure of a bigger sideways corrective structure, and then a over here wave A. Then you're going to be looking for either a wave B, or of course this can be a W as well over here. Then you're looking for a wave B or a wave X, for then again a move to the downside in a wave Y or a wave C. Because if this is the high of a wave 5 instead of a wave B, right, a WXY is not allowed to be part of a wave Y or a wave C. So this count over here basically tells you, hey, this is the high of a wave 5, which means we have finished a bullish structure to the upside, right? So potentially 1, 2, 3, 4, 5 finished. But then you have the higher degree Elliott wave count, 1, 2, 3, looking for 4 and then 5. But the higher degree Elliott wave count most commonly has a longer wave 4 than the lower degree Elliott wave count wave 4. And this is the lower degree, and now you're working on a higher degree. So that means you're basically going to be ranging for a lot longer as well. And then over here, W, X, Y, taking even more time than this one over here in a very, very sideways structure. Also, a higher degree wave 4 tends to finish around the lower degree wave 4, which is basically inside this range, which is basically between 32.9k and 35k. So that is going to be a very, very important range, maybe for the upcoming week as well. Now, I already showed you some of these confluences. We have the triple bottom, double bottom as well, and the key level over here on the 1 hour chart, which is basically the low of this candle, start of the gap. Gaps always act as, or can act as a bit of support where you enter or hit the gap. And most of the time you get a reaction at least for a little bit of upside. The moment you come down again and close over here inside the gap, probabilities increase. You are going to fill the gap to the downside all the way down here, which is then 31.6k. If you then look at the CVD again, but in a little bit more detail, as mentioned before, then over here you can see that currently we do have some bullish CVD divergences. What is interesting is that throughout the move to the downside, we did have constant bearish CVD divergences as well. So there is some absorption going on of market longs throughout the move to the downside. And we didn't yet take any of the lows over here for potentially these big positions to offload the Bitcoin that they got in their short positions. But we do have locally some bullish CVD. This one already played out. We saw this one on stream, right, which gave the probabilities for a move to the upside. Very nice indeed. And then here more locally, we also currently have bullish CVD divergences. If I quickly refresh the chart, you can see here as well, higher low in price, but on yellow, look at yellow over here, lower low on the CVD, and also on blue, lower low on the CVD. So bullish CVD divergence, and the target would be taking this high. And if price does move to the upside, take this high, then I would be looking at this resistance here, 35.2 to 35.4k. If you then finally look at the probabilities of all the different scenarios, then I like to keep it quite simple, because if we look at what is happening over here, then currently all the scenarios are aiming for the double bottoms and the triple bottoms to be taken eventually. Even if price moves to the upside, we know the resistance, we know the area of interest over here. In general, probabilities are higher to take the triple bottom. The double bottom we have over here, low 1, low 2, low 3. We have 2 lows over here as well, and we also have lows over here. So it's just so attractive to eventually move to the downside, and all the scenarios are showing that as well. And on the low time frame, because a 1112 is having lower probability at the moment compared to the more bullish scenarios where you have corrective structures to the downside, it means that zooming out to the 1 hour and the 4 hour, probabilities are higher. We will eventually then move back towards the upside after taking the lows to continue our way to 40k. I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.